Okay, so this video is going to deal directly with the Goods and Services Tax, or GST. So just some points to start off with. So for GST, the obligation is actually on the supplier of goods or services to collect the amount which is subject to GST. So for example, if a shop sells you something for $5.50, 50 cents of that will be GST. And so the shop is obliged to actually collect the amount and pass it on to the ATO. So for example, when you go and buy something at the shop, you don't pay the $5 to the retailer and then go pay another 50 cents to the tax office. It's actually the supplier, i.e. the shop, who collects the tax. Next, so the cost of GST is usually paid for by the end consumer. So in the end, the actual GST, which is added on to the value of the product, the cost is borne by the consumer. So basically, the way you can tell that is by this third point here. GST must be included in the price. So whenever you go buy something that's subject to GST, GST is already built into that price. And so you're paying for the value of the product plus the GST amount. So GST is simply a 10% rate. So it's just additional 10% on the base value of the good. And business activity statements, or the BAS, is just a form that businesses lodge to actually record and pay their GST liability to the tax office. So GST Registration and Accounting. So in terms of being required to register for GST, non-charitable organisations must register. The turnover is larger than $75,000. However, if it's less than $75,000, they still have the option to register if they'd like. Charitable organisations, they must register if their turnover is more than $150,000, but again, they also have the option to register if it's less than $150,000. In terms of GST accounting, the turnover is less than $2 million, they may use cash accounting, and if it's more than $2 million, then the company must use accrual accounting, unless they have been given specific permission otherwise. So next we're going to talk about the types of supply for GST purposes. So the first one is GST-free supplies. This simply means that GST is not payable on these goods. So when you purchase goods in these categories, GST will not be built into the price because they are exempt from GST. So essentially, GST is not payable and income tax credits are claimable. Now we'll talk about income tax credits in the next slide, so I'm just going to ignore them, what they mean for now. So you can see here some of the examples in the GST-free category of basic food, health, education, childcare, exports, religious services, water and sewerage, cars for disabled, certain transport. So international transport's an example. Sale of going concern businesses. So if I sold you a business which I expect to continue running, it's exempt from GST. And inward duty. So inward duty is simply if I go buy a t-shirt while I'm in America and I bring it back, that's inward duty and that's exempt from GST. Okay. Another point I'll make, basic food is really basic elements. As soon as you do anything to it, it's no longer basic. So if I create, a packaged lasagna, that's not basic food anymore. However, a piece of broccoli that's come from the farm and selling it straight off, that's considered basic food. Okay, taxable supplies are supplies that are subject to GST. And so what makes a taxable supply is that they're made in the course of business and the business is trying to receive payment for those. So they're connected with Australia in some way. So this could be that they're actually imported in from overseas, and then once they've come to Australia, you're then selling them to consumers. That's connected with Australia. Or if you import everything from overseas, but you assemble it in Australia, that's also been connected with Australia. Also, for a taxable supply, you need to be registered or required to be registered for GST. So effectively, taxable supplies is anything that doesn't fit into the GST-free or input taxed categories. So again, taxable supplies, input tax credits are claimable. Okay, so next we've got input taxed supplies. So GST is again not payable on these types of supplies, and again, tax credits are also not claimable for these. The input tax supplies, they can be financial supplies such as loans, shares, or derivatives. Residential rent. However, commercial rent is usually considered a taxable supply. Or sale of residential property, except for the original sale. So if I construct a property for the very first time, because I'm a property developer, and I sell it to you, then that will be the original sale, and that could be subject to GST. However, if you think of it, if you're selling a second-hand house, I know you don't really consider houses in that way, but if it's second-hand, being sold for the second time or more, then it is an input tax supply, and so GST is not payable. Okay, so now we're going to talk about input tax credits, which I kind of ignored what they were in the last slide. So entities can claim an an input tax credit if they make a creditable acquisition, which is simply when they purchase a taxable supply as an input. So the value of the the input tax credit is equal to the GST that they paid on the supply. So we'll look at that in the example in a second. So if the company sells a GST-free supply, then they will be refunded the input tax credits. But if they sell a taxable supply, the input tax credits will reduce their GST liability. So it will reduce the amount they then have to pay to the tax office. And again, you must be registered for GST if you're actually going to claim input tax credits. So now I'll just take us through an example to just explain how input tax credits actually work. So let's say company A here sells a good to company B for $110. So we know that GST is always included in the price of a good. So we know that this is actually made up $100 of the base value and $10 of GST. So when company A makes this sale, they'll receive $110, and so $10 of that will be GST. So company A will pay $10 of GST to the tax office. Let's say company B uses that input to create their good. Company B is going to sell their good to company C for $220. So again, we know GST is 10% and it's built in to the price of the good. So company B will collect $20 GST on the sale of this good because we know the value is only $200 and the GST is $20, bringing a total of $220. And then they have received an input tax credit of $10. Now, they received this $10 input tax credit because they paid $10 GST to company A when they bought their input. Because they've now collected $20 GST from company C, they're liable to pay the $20, but they're able to claim the $10 they already paid to company A, and so that will provide a net $10 obligation to the tax office that they have to pay for GST. Okay, so company C then uses that input they bought from company B, and they're going to sell it to the end consumer. So company C goes, right, we want to sell this good for $300, but we need to add 10% GST. That's going to bring the total price to $330. So that means when they sell it, they're going to collect $30 GST. However, they already paid $20 GST to company B when they bought that input. So that means company C is going to be able to claim a $20 input tax credit. So that will reduce their GST liabilities by $20, meaning that they will also pay $10 to the tax office. So you can see here in the end that company C collected $30 GST, and the way it's worked out is that company A will pay $10 to the tax office in GST, company B will pay $10 as well, and company C will pay $10. So the total $30 GST is received by the tax office, but it's received from all the different entities in the different proportions to the amount that they paid and to what they then charged. So what this does is it reduces a cascading effect up the line of companies of GST. So imagine if input tax credits didn't exist. Company A would be paying $10 GST to the tax office, company B would pay $20, and company C would pay $30. That would be a total of $60 GST, which would be double the actual net amount of $30 which was paid. Okay, so now we've got taxable imports. So an import is taxable if it's purchased for a creditable purpose. So this is essentially just if it's purchased for sale in the course of business. GST is only applied to the import of goods. And so an import is also only taxable if it is considered to be a taxable supply in Australia. So if it's a GST-free item or an input taxed item in Australia, that would mean that it's a non-taxable import. Again, if it qualifies for customs duty concessions or the gross value is below $1,000, then it would be exempt from GST upon import. So again, the importer must be registered or required to be registered for GST if they wish to claim income tax credits for any GST paid. And just another point here, so the customs value, insurance and transport costs, and customs duty are included in the imported value. So this is the value before GST is applied. So for example, if I was importing something which cost me $900, but then I actually had to pay an extra $150 for transport costs, that means the total value of my goods would be $1,050, which would mean I would have to pay GST on that import. Pause here. So first question, Ben pays $550 for a laptop. Calculate the GST he paid. So we know that the GST is built in to the price of this good. So the way that we're going to break down the price into the actual GST element is price divided by 11. So let's just say the price before GST added was 100%. Say, because we know GST is equal to 10%, we could say that there might be 10 parts to the before GST price. However, when you add GST, it becomes 110%. As the rate's again 10%, you could say that there might be 11 parts to the price. And so if you break it down into one of those 11 parts, it'd be equal to 10%, and so it'd be equal to the amount of GST. And that's why we're dividing by 11. So if we go $550 divided by 11, that'll be equal to $50 GST. Okay, so that's not too bad. It's relatively easy. Again here, another question. Ben intends to sell a book set for $200. How much GST should he charge? So in this case, the question is talking about a price before GST has been added. So we could say that is 100% of the value of the product, but we know we need to add 10%. So the way we do that would be to simply, as we know probably, to take the price, multiply it by 200%, multiply it by 10%, which would mean it'd be $20 GST that would need to be charged. That would take, obviously, the total price to $220. So again, that's relatively straightforward. Another quick example here to do with imports. So let's say Ben Limited imports $9,000 worth of stock. The company pays $1,000 for transport and insurance costs. How much GST must the company pay? So again, the value of this import is the $9,000 of the cost plus the $1,000 for transport and insurance. We spoke about that just before as to why that's the case. It's because I think transport insurance, any customs duty, etc., is included in the value of the price. So to work out how much GST is liable, we'll take the total value, which is $10,000, multiply it by the 10%, and we know that would come to $1,000 GST that must be paid. Just another note, so Ben Limited could actually claim input tax credits for the total amount of GST if they were to then sell it on further. So I hope the video was useful, and good luck with any questions you attempt.